All right, welcome to Talk Tickers. Today, we're digging into Acushnet. Yep, the folks behind Titleist and FootJoy, ticker Golf, and their latest Q3 2025 earnings. Let's get right into it.
So right off the bat, things got interesting. We're looking at what you'd call a classic mixed bag of a quarter. On one hand, they absolutely crushed it on revenue, pulling in almost $658 million when the street was only looking for about $635 million. But, and there's usually a but, right? The bottom line, their earnings per share came in just a little light. They hit 81 cents when the expectation was 85. So you've got this puzzle, a beat on sales, but a miss on profit.
So with that kind of conflicting news, what do you think the market did? You might expect a shrug, maybe even a drop. Nope. The market loved it. The stock shot up and closed the day with a solid 4% gain.
And that right there is the big question we're going to unpack today. Why on earth did a stock with an earnings miss rally like that? In a market that's usually brutal about these things, what did investors see that made them so bullish?
Okay, so here's our game plan. We'll start with the headline numbers. Then we'll dig into what was behind that big revenue beat. After that, we got to talk about the headwinds they're facing. Then we'll try to get inside the market's head to see why it reacted the way it did. And we'll wrap it all up with a trade idea for the next call.
All right, let's do it. First up, the headline numbers.
Okay, so let's break this down. That revenue beat, it wasn't small. We're talking over $22 million higher than expected. That's a 6% jump from last year. Now compare that to the earnings miss. Just 4 cents. It's almost a rounding error. And check out the adjusted EBITDA. That's a key measure of core profitability. It was up over 10% year over year. So underneath it all, the engine of the business is actually running really, really strong.
So where did all that extra cash come from? Let's take a look.
Wow, look at this. It wasn't just one thing, it was everything. Their main business, Titleist golf equipment, up almost 6%. FootJoy, their apparel line, up a respectable 4%. But the real star of the show, golf gear. It just exploded, up over 14%. This tells you it's not a one-trick pony. The strength was across the board.
And if you want to know why, you just have to listen to the CEO, David Marr. He laid it out perfectly. He said the growth is coming from their heavy hitters. The Pro V1 franchise is still king, and the launch of their new T-Series irons was, in his words, very successful. This is brand power in action, plain and simple.
So you see the picture they're painting, right? You've got these legendary products like the Pro V1, you've got hot new launches like the T-Series irons and SM10 wedges, and they're getting higher prices for their clubs. Demand in the US and Europe is strong. And maybe the most important part? They said channel inventories are seasonally low. That's Wall Street speak for the shelves are getting empty, which is a fantastic sign for future orders.
Okay, so the sales story is great, but we know it's not all sunshine and roses because something squeezed those profits. Let's flip the coin and look at the headwinds.
And here they are, the usual suspects. The big one is pressure on their gross margins, which dropped a bit. Why? Two main reasons. Tariffs, we'll get to that in a second, and the mix of what they sold. On top of that, things were a little softer in Asia, specifically Japan and Korea, and they're also in the middle of a big strategic shift with FootJoy, which is causing a little turbulence right now.
Okay, let's talk tariffs, because this is the thing you need to pay attention to if you follow this stock. This year, it's a $30 million problem. That's a lot, but it's manageable. The real jaw-dropper is what they're forecasting for 2026, a potential hit of over $70 million. That is a huge number, and it's the big gray cloud hanging over the company right now.
And about that FootJoy situation, don't mistake that for a problem. It's actually a deliberate strategy. They're basically saying, we're getting out of the cheaper stuff to focus on being a premium brand. It's a classic play. Take a small hit on sales now to build a stronger, more profitable brand for the long haul. Pretty smart, actually.
So you've got this tug of war, right? Amazing demand on one side, these scary tariff headwinds on the other. So why did the stock jump 4%? What made the bulls so confident? This right here is the answer. It's the magic words every investor wants to hear. They raised guidance. They're now telling the market they expect to bring in more revenue and make more in core profit for the full year than they previously thought. For Wall Street, that's like a shot of adrenaline. And that's the whole story in a nutshell. Investors are forward-looking. They basically said, okay, you missed earnings by a few pennies this quarter. We don't care. What we do care about is that your business is so strong, you're raising your forecast for the entire year. The promise of future growth completely overshadowed a tiny bump in the road from the last 3 months. But let's put this in perspective for a second. Even with this great day, if you look at the past year,
golf has actually underperformed its peers in the consumer space. What that tells me is that investors were already worried about things like tariffs. So when the company came out with such a strong report and guide, it was a huge relief, and that's why you saw such a powerful reaction.
All right, so that's the breakdown of Q3. Now for the fun part, let's talk about what happens next.
So, what's the tripe?
So here's how you have to think about it. The bull case is pretty straightforward. The products are hot, people are buying, and that momentum is going to power them through the headwinds. The bear case, though, is all about that $70 million tariff number for 2026. It's a massive question mark. Can they really find a way to offset that without crushing their profit margins? So the catalyst is the next earnings call. We need to see that growth continue, and we absolutely need to hear a detailed plan for how they're going to fight back against those tariffs.
So here's how we're putting it all together. 1, the market was right to cheer. The business is firing on all cylinders. 2, the stock has been lagging for a reason. Investors are genuinely worried about that tariff issue. And 3, because that 2026 risk is so big and so well known, it's probably going to act like a cap on the stock for a while. It's hard to see it really taking off until we get more clarity.
And for all those reasons, we're giving this a rating of market perform. Look, it's a great company that's doing almost everything right, but they're driving straight into a massive, known headwind. We think the stock will basically tread water and perform in line with the overall market until we know exactly how they're going to handle that tariff storm in 2026.
And as always, this is not financial advice.